at that time when millions of these things are coming off of a line like we just saw with cars, they're going to be fully autonomous. They're going to come off, and the way you've described it, they're going to be able to come in my house, and I'm going to be able to say, all right, do the dishes. Now I need you to walk the dog.
Absolutely.
Hold the baby.
In fact, you really won't even need to. It'll figure out what you probably want and do what you probably want without you even having to ask.
How many GPUs are you going to need for that?
Well, quite a few GPUs. We do have our own program called Dojo for training, which I think will be helpful.
Right now it's contributing about 5% towards self-driving, right?
Yeah. So
is that the one in New York State?
Dojo? Yeah, it's in New York. So, but we expect to still buy a lot of GPUs from Nvidia, some from AMD, and maybe from others. And as long as Nvidia is better than what we make, we'll keep buying from Nvidia.
Is that the case right now?
It is, yeah.
Yeah. I mean, you're obviously buying them for XAI, the Memphis.
Big time.
Big time, right?
Yeah, XAI is building the most powerful. We have the most powerful. I think we have the most powerful training cluster in the world right now, which is over 200,000 GPUs training coherently. You're
at 200,000 already now.
Yes.
There in Memphis, that facility that you
yes.
put okay.
Yes.
And where are you going?
And we'll be at the million GPU level in a location just near Memphis.
Wait, a million GPUs for a new location, or 800,000 additional GPUs?
A million of the next generation GPUs.
So Blackwell.
Well, yeah.
Nvidia's results for the quarter ending in April 2025 are anticipated to show a year-over-year improvement in profitability on greater revenues. Although the company's earnings picture is well represented by this well-known consensus view, the actual results comparison to these projections is a significant aspect that could affect the stock price in the near future. If these important figures exceed projections in the next earnings report, which is anticipated to be released on May 28th, the stock may rise. However, if they fail, the stock can decline. While the sustainability of the immediate price change and future earnings expectations will primarily depend on management's description of business conditions, on the results call, it's worth evaluating the possibility of a good EPS surprise. This provider of graphics chips for gaming and artificial intelligence is predicted to post quarterly earnings of $0.87 per share in its upcoming report, which represents a year-over-year change of 42.6%. It is anticipated that revenues will reach $42.71 billion, a 64% increase over the previous quarter. Over the past 30 days, the consensus EPS estimate for the quarter has been revised down by 0.93% to its current level. The covering analysts' combined reevaluation of their initial estimates throughout this time is reflected in this. Investors should be aware that the overall change may not always reflect the direction of estimate adjustments made by each covered analyst. A company's business conditions for the period whose results are being released can be inferred from estimate adjustments made before to the earnings announcement. This realization forms the basis of our exclusive earnings ESP expected surprise prediction methodology. The most accurate estimate, which is a more recent version of the consensus EPS estimate, is compared to the consensus estimate for the quarter by the earnings ESP. The notion here is that analysts revising their projections immediately before an earnings release have the freshest information, which could potentially be more accurate than what they and others contributing to the consensus had projected previously. Thus, a positive or negative earnings ESP value theoretically indicates the expected departure of the actual earnings from the consensus estimate. But only for positive ESP readings does the model's forecasting ability matter. Strong earnings beat predictions can be made with a positive earnings ESP, especially when paired with a rank number 1, strong buy, 2, buy, or 3, hold. According to our study, stocks that have this combination generate a positive surprise around 70% of the time, and a strong rank actually boosts earnings ESP's predictive ability. Please be aware that an earnings miss is not always indicated by a negative earnings ESP number. According to our research, firms with negative earnings ESP readings and/or a rank of 4, sell, or 5, strong sell, make it difficult to predict an earnings beat with any level of confidence. It appears that analysts have recently grown pessimistic about Nvidia's profit prospects, since the most accurate estimate is lower than the consensus estimate. This has led to a 5.24% earnings ESP. In contrast, the stock currently holds the number 3 rank. It is therefore challenging to make a firm prediction that Nvidia will surpass the consensus EPS projection given this combination. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now let's get back to the video.
Now, because Nvidia, yes, crushes it on the week, up 15%, more than $400 billion in market cap added. It's, again, a $3 trillion company. Are there legs left to run with Nvidia's up and to the right, and indeed tech more broadly?
Well, I think that Nvidia still has earnings to be announced, and we expect that the earnings are going to be strong enough to keep the optimism going. We shouldn't forget that Nvidia had a very difficult quarter, and we saw a very significant fall in its share price and also in its valuation. And right now, with the arrival of the good news and big clients that actually counterweight the idea and the worries that the big technology clients could be finding their ways out of Nvidia, is obviously a very positive news. And we think that Nvidia does have potential to extend and to, well, extend its rally on the Middle East deals if obviously the Middle East deals materialize and there is not a problem barrier in the future. Yeah, so definitely, yes, it has been an outright positive for Nvidia, we think.
I mean, it's been an outright positive for many a tech stock this week. I'm looking at Alphabet up more than 9% over the last 5 trading days. That's despite the ongoing worries that this is a company that might be forced to break apart. Meta also investigation with its monopolistic, as has been deemed by the FTC, monopolistic position. What do you think are some of the risks that investors perhaps aren't tuning into right now?
Well, one of the other risks that we see, because we're in Europe, is that if the trade negotiations don't go well with the European Union, the European regulators will be going after companies like Google and Facebook, big technology companies. They have been very clear warning the United States about that. So I think that one of the trade risks is on these companies that have been spared so far because they are offering digital services, and it was mostly the companies with complex international supply chains like Nvidia, like Google, Apple, that have been very, very hardly hit. We think that there are still risks there that have maybe not be fully priced in. Obviously, the risks are still two-sided because there is always a chance that the European Union and the US strike a deal. But if that's not the case, I think that Microsoft, Google, and Facebook are also going to come under pressure.
According to Nvidia CEO Jensen Huang, American companies have lost out on billions of dollars in potential sales as a result of the United States' ban on exporting AI processors to China. Huang said that the Biden administration's 2023 AI diffusion rule was based on essentially false presumptions. He claimed that the regulation, which prohibited the shipment of expensive processors to China, was intended to slow down China's advancement in artificial intelligence but instead benefited Chinese vendors like Huawei Technologies. Huang pointed out that Nvidia's market share of Chinese AI chips has decreased from 95% to roughly 50% after the regulation went into force. They would love for us to never return, he added, warning that China's domestic AI business is growing quickly. In addition to a $5.5 billion penalty announced in April, Huang anticipated that restrictions on Nvidia's H20 chips will cost the company $15 billion in revenue. To comply with regulations, the business is currently creating a modified Blackwell chip with slower memory. Regarding AI trade policy, Huang also supported Donald Trump, arguing that the former president's intentions to remove the restrictions are a more sensible course of action. Early Wednesday trade saw a 1% decrease in Nvidia's stock price. Due to tariff uncertainties, the largest asset manager in the world is increasing its bets on artificial intelligence within its U.S. model portfolios while reducing its overall equities risk. With the iShares AI Innovation and Tech Active ETF, BlackRock is expanding its exposure to AI in its equity-heavy portfolios. After receiving approximately $436 million on Tuesday, the greatest one-day net inflows since the fund's launch last October, the actively managed fund's size quadrupled. The move by BlackRock highlights how institutional asset managers are hesitant to maximize their exposures across the whole stock market, preferring to focus on the biggest beneficiaries of this technologically advanced period. With significant holdings in Nvidia, Broadcom, and Meta platforms, BAI has increased by 29% in the past month as riskier assets have recovered from lows caused by tariffs. Tech remains one of our highest conviction and longest-running portfolio overweights, and inside Tech AI is the highest conviction drivers. Michael Gates, lead portfolio manager for BlackRock's $160 billion target allocation ETF model portfolio suite. While the AI trade is sensitive to tariff headlines and some investors have raised valuation issues, some analysts are upbeat on the profits forecast for artificial intelligence-linked sectors for the balance of the year. Following the recent risk-on rally, BlackRock is likewise reducing its equity exposure across all of its U.S. models. The fund manager is adding value companies outside of the U.S., decreasing an overweight allocation to growth equities, and cutting its overweight on stocks compared to bonds from 3% to 1%. According to Gates, the actions are a reaction to the ambiguity surrounding trade talks, rather than a sign of waning faith in U.S. exceptionalism. Since supply chains may take some time to adjust, and company confidence is still vulnerable to changing trade dynamics, we believe that the bigger worry about tariffs is that they could slightly slow down global growth, he continued. About $822 million exited the iShares S&P 500 Growth ETF IVW, while $6.28 billion fell from the iShares Core S&P 500 ETF IVV, the largest one-day decline since March. A net inflow of $9 or $12 million was received by the iShares MSCI EAFE Value ETF, EFV, the biggest since September. It also added to its equity-heavy portfolios the iShares US Thematic Rotation Active ETF, THRO, which saw the largest one-day flow ever on Tuesday. Bringing in over $3 billion in fixed income, the iShares 05-Year TIPS Bond, ETF, STIP, received a net inflow of $553 million, the largest since 2022. Model portfolios bundle funds into pre-made strategies to sell to financial advisors and institutions. According to Broadridge Financial Solutions, model assets could reach $11 trillion by 2028, with ETFs playing a major role in that growth. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now, let's dive into today's video.
I know that you have a particular interest in LLMs and Meta's behemoth, but I want to tie it back to Nvidia, to the point that you're making here, because if we as investors can't really get clarity on who's going to have the best LLM, what the timelines are going to look like, the argument I've heard from sources like Dan Ives is you buy what's juicing the LLMs regardless, aka Nvidia. How do you rate that framework of thinking for investors?
I think that's going to work right up to the point where it doesn't, because what this is a momentum investing play, right? And I love momentum investing when it's working. But here's what the problem is. The top buyers of Nvidia are playing this game that they are going to continue investing at the same rate their competition is, because the minute one of them takes their foot off the gas pedal, they're going to become irrelevant. Not just lose first place, we're talking irrelevancy, right? So that's why Dan's argument works. Now, I'm not saying they would collude, but they might get to a point where they say, oh, gee, the promise of truly autonomous learning, where we don't have to have any human governors on there, they just know the truth. If that can be formulated or, programmed, we'll say, maybe this is a winner in perpetuity for as long as I'm going to be in this business, right? But I don't think that's the case. So I think there's going to be bumps along the way where it will call for lower investment. And by lower investment, that you don't need every last NVIDIA chip that's coming off the line.
What do you believe about Magnificent 7 performance relative to the rest of the 493 in the S&P in your outlook?
Well, I think it's merited. They're showing growth. I am a growth at a reasonable price investor, so I don't necessarily own a lot of the Magnificent 7. But I do know this, Wall Street over time rewards growth. And these companies have proven year after year that they have some kind of magic formula to get whatever customers they need. And it's not direct in many of their cases, right? Because Google and Meta, the users don't pay for it, the advertisers do. But as long as you can get paying customers to keep paying, they're going to win.
Daniel Newman, CEO of Futurum, a technology research firm, recently stated that Nvidia's recent decision to open its infrastructure to other companies to a certain extent is largely bullish for Nvidia stock. He said that the giant chipmaker's actions will drive innovation both inside and outside of Nvidia, as well as help the companies that are developing robots move more quickly. Nvidia's decisions will also help the big cloud infrastructure players grow, while facilitating the interconnection of machines and the connection of the physical world with AI. Additionally, the big cloud infrastructure players will be able to go big on their own while still benefiting from where Nvidia is leading, Newman suggested, adding that Nvidia's efforts with Groot, Nvidia is leading in the ability to connect machines to deal with these massive amounts of data. Its open-source model for humanoid robot development will help other firms build robots more quickly, Newman added. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
We continue to see some weakness from the overnight session here. We also had the VIX expiration happening this morning as well. So that probably put a little bit of pressure and a little bit of volatility in the markets. And once again, when we're kind of looking at the intraday levels, where are we coming back to? The 5905, 5900-ish level. That's where we are at right now. That's also coinciding with the 200 period moving average on the 15-minute chart here. So we want to be able to try to recover. We did see some weakness yesterday. When you're looking at the volume, it wasn't really too aggressive to the upside or downside, so still fairly light volume here. But once again, on an intraday basis, what we're really trying to look for is a recovery of this 5,900 level as an area of support, having some buyers really try to step in. Now, we do have actually a wider range to the upside at 5,975, so we have a pretty wide gap. 75 points is significant, and with the volume that we've had, maybe we do actually see, once again, a little bit more of a consolidated move. So I'm not sure if we're going to be able to get all the way up to that 5,975, but it's on the radar. And then any type of further breakdown, 58.75 to the downside, kind of that line in the sand that we do see a little bit more of a breakdown in the market here. Unfortunately, if you kind of look at the 4-hour chart, we are actually testing the upper trend line from the April lows, and we're testing that right now. So we really don't want to break that trend line in general, because that could actually create a shift in sentiment where selling activity does kind of take place here. But overall, you're not really seeing any type of strength in any sector at this point in time. Communication services may be trying to recover here. It looks like it's about to go flat, but we are not seeing this kind of shift between defensive sectors and really risk-on type of sectors. It seems like the market's really kind of selling everything right now. But once again, VIX expiration can also create some of that volatility, and the lack of economic data kind of puts us in a little bit of a holding pattern for now, allows us to really kind of digest what we've had over the last couple of weeks here. But if we do see any type of further breakdown to the downside, looking at 57.90 as your first area of potential support, that also kind of aligns with that 200 period moving average in purple on this chart.
Yeah, understood. You know, we're watching oil, which has been creeping higher. We also have the constant story of the tensions in the Middle East, and now there's reports that Israel may have its eye on Iran's nuclear stations. And, you know, while that hasn't really come out too much, or there hasn't been more to that, it was enough to be talked about on Wall Street today. We haven't received many confirmations of that report. However, it's pushing crude, right?
It is, and initially when the market opened yesterday evening for the futures, we did see crude push above that $64 level, but it has faded ever since because we have not had any type of follow-up confirmation from the Israeli government as well as the U.S. government or any other news outlets that have really confirmed the story here. So I think the market, when you're looking at the energy patch, is really kind of holding back a little bit when it comes to this geopolitical risk. And the real risk is going to be supply chains and also refiners being hit. Now, for Iran, export around 3 million barrels per day, give or take, depending on the source that you track here. But that could actually have a disruption when it comes to China flows. And so that's something that also we have to be mindful of. That Middle East conflict is not isolated. It will have some ramifications. And obviously we're trying to make a deal with China. So that would probably put a little bit of a speed bump if we did see this action kind of going through. But overall, we continue to reject that 50-period moving average on the daily chart for crude. That's the next area of resistance that we really got to get above. And you really want to try to get above $65 if you are a bull right now. But this consolidation is something that a lot of bulls for crude in general actually does appreciate, knowing the fact that we are going into driving season and we are seeing refining rates for the most part leveling off, which should also tighten supply here. So let's see how this actually resolves today. On the inflationary front though, Nicole, we have seen crude up around 7%, 7.5% from those lows. Gasoline is only around 6% away from the highs, 6.5% away from the highs year to date. So there probably will be some inflationary pressures from the energy sector being reflected in CPI or PPI if this trend does continue, which is also not really good when you're looking at the administration's policies and what they want to be able to accomplish, as well as the Fed trying to get a reason or have a reason to be able to cut rates. So this one is definitely on the watch list, at least for today, to see how this actually resolves itself.
Yeah, understood. I'm seeing 10-year bond yields above 4.5%. I woke up, quickly checked the 30-year above 5%, right back to those levels of late 2023. Some concerns there. And then this auction today, very important. We got to make sure people want to buy U.S. bonds, right?
Yeah, we'll keep this one on focus. We have to be mindful. The 20-year Treasury auction is not a popular auction just in general. So everybody will be focusing on it, but I wouldn't hang our hats on it completely, just given the fact that it's not really a popular maturity. In fact, you have some previous Treasury secretaries that even kind of threw out the idea of maybe reducing or even eliminating that offering just in general because of the lack of popularity. But when you're looking at the 10-year, the level to really focus on is 4.55%. We continue to try to test that and reject. Seems like once we get to that level, we do have some buyers really stepping into the yield complex here, but we do have this inverse head and shoulders pattern taking place and is still intact for right now. So that neckline is going to be key. Could the 20-year auction actually move the needle here and move this to the upside? If it does not look really great, that could be the case here. But once again, it might be a headline mover for today, but the 20-year, we have to discount it a little bit. The offering size is fairly light and the demand is also fairly light just in general compared to the 10-year or even the 5-year Treasury auctions.
Yep.